Nvidia versus Meta is the primary narrative driving a massive shift on Wall Street right now, in May of 2026. And if you are holding cash, you are facing a critical choice that will define your portfolio for the next decade. We have moved past the initial AI hype of 2023 and 2024, and the empty promises are gone. The market isn't buying stories anymore, it's buying actual earnings. This brings us to a massive showdown between two tech titans that are taking completely opposite approaches to the AI revolution. On one side, you have Nvidia, trading at roughly $224 a share with a staggering $5 trillion market cap, fresh off a jaw-dropping fiscal year 2026 where they pulled in over $215 billion in revenue. On the other side, you have Meta Platforms, sitting near $604 a share with a valuation of $1.5 trillion, completely transforming itself from a simple social media company into an open-source AI superpower. One sells the physical picks and shovels to the entire world. The other uses those shovels to build an unstoppable ecosystem used by billions of people every single day. But here's the catch. One of these stocks is massively overextended and faces a brutal reality check in the coming months, while the other is quietly trading at a steep discount, setting itself up for a historic run toward $1,000 a share before this year ends. If you allocate your capital incorrectly right now, you risk catching a falling knife or missing out on the easiest 50% gain left in the Magnificent Seven. Think about it. The entire tech industry is pouring hundreds of billions of dollars into capital expenditures, and a massive chunk of that money is flowing directly from Meta's bank accounts straight into Nvidia's pocket. It looks like an infinite money loop, but the cracks are starting to show because Meta's projected capital expenditure for 2026 is crossing a mind-boggling $115 billion. The market is starting to ask a dangerous question. What happens when the biggest tech buyers finally stop buying? If Meta decides they have enough chips, Nvidia's entire valuation model collapses overnight, creating a catastrophic trap for retail investors who are buying the peak. But wait, it gets even more volatile because just weeks ago, Meta shocked the entire global financial market by unleashing Llama 5, a massive 600 billion parameter open-source AI model trained on a historic cluster of over 500,000 Nvidia Blackwell B200 GPUs. This isn't just another chatbot update. This is a systematic destruction of the business models of OpenAI and Google. By giving away a model that features advanced recursive self-improvement and a 5 million token context window completely for free, Mark Zuckerberg is effectively making proprietary AI worthless. This brings us to an unbelievable paradox. Meta is spending billions on Nvidia's chips just to give the resulting software away to the public for free. How does a company make money by giving away its crown jewels? If you think Zuckerberg is doing this out of the goodness of his heart, you are missing the entire plot of this economic war. By open-sourcing Llama 5, Meta ensures that every startup, enterprise, and developer in the world builds their infrastructure on Meta's architecture, completely freezing out competitors and forcing the industry to adapt to Meta's standards. This strategy is already paying off massively because Meta's core business, Facebook, Instagram, WhatsApp, and Threads, is seeing unprecedented monetization. Their AI-driven ad targeting systems have gotten so advanced that first quarter sales skyrocketed by over 33% year over year. Yet, despite having some of the highest growth rates of any mega-cap technology firm on Earth, Meta's stock is trading at a deep, unexplained discount compared to its tech peers. If you look at operating
cash flow, Meta is trading in the high teens, making it a statistical bargain in a market that is otherwise incredibly bloated. Meanwhile, Jensen Huang just stood on stage and opened up a terrifyingly ambitious new frontier with the official launch of the Nvidia Vera Rubin architecture. This isn't just a minor chip upgrade. It is a massive supercomputing platform consisting of 7 breakthrough chips, including the Rubin GPU and the Vera CPU, manufactured on TSMC's ultra-advanced 3-nanometer process. Nvidia claims this setup can train complex AI models with 1/4 the number of GPUs compared to their previous Blackwell platform, while achieving a massive 10 times increase in agentic inference throughput. But this incredible leap in efficiency hides a devastating double-edged sword for Nvidia's stock price. If the new Rubin chips are 4 times more efficient at training models, that means tech companies won't need to buy nearly as many physical chips in the future to achieve the same computing power. Nvidia might be innovating themselves right out of a supply shortage, and when supply catches up to demand, their incredible 70% gross margins will absolutely plummet. Investors paying a premium for Nvidia today are betting that the demand for silicon will remain infinite forever, completely ignoring the basic laws of cyclical hardware markets. Let's look at the actual numbers because they tell a story that Wall Street analysts are desperately trying to hide from you. Nvidia's current price-to-earnings ratio is sitting around 45 times, which reflects immense expectations of non-stop exponential growth. They hit an unbelievable milestone, but maintaining a growth rate where quarterly revenue jumps 73% year over year gets mathematically impossible as the baseline numbers reach hundreds of billions of dollars. They are running out of headroom, and any slight guidance miss will spark a massive institutional sell-off. Compare that to Meta, which is currently sitting at a forward PE ratio of just 24 times, a valuation that looks incredibly safe and defensive in this economic environment. Institutional giants like BlackRock and Vanguard aren't blind. They have been aggressively rotating their capital out of high-flying hardware names and loading up heavily on Meta during the early months of this year. They see Meta as the ultimate efficiency play because they are using AI to automate internal coding, streamline content moderation, and eliminate billions of dollars in operational costs, driving their free cash flow to historic highs. The true battlefield of 2026 isn't about who can build the biggest data center. It's about who can actually squeeze real cash flow out of the end user. Nvidia is a pure hardware vendor, and history shows us that hardware vendors eventually get commoditized once the initial infrastructure build-out ends. Think about the Cisco systems of the dot-com boom. They could do no wrong while the internet pipes were being laid. But once the network was built, the profit shifted entirely to the software companies that ran on top of those networks. Meta is positioned to be the software giant of the AI era, using Nvidia's hardware to build an unassailable digital empire. Look closely at what Mark Zuckerberg is doing with consumer hardware right now, because it completely alters the thesis for this stock. The Ray-Ban Meta smart glasses have quietly become the absolute breakout consumer tech hit of the mid-2020s, moving over 7 million units and transforming from a simple gadget into a primary AI interface. When you walk around wearing these glasses, you aren't typing into a prompt box. You are interacting with Meta AI in real time as it looks through your eyes and hears through your ears. Meta is successfully bypassing Apple's App Store and Google's Android ecosystem to own the next physical interface of human-AI interaction. But don't think Nvidia is just sitting around waiting to be replaced by software apps, because Jensen Huang is executing a brilliant, hidden strategy to lock in corporate customers forever. Nvidia isn't just selling chips anymore. They are expanding the Nvidia DSX platform, providing complete AI factory blueprints that integrate compute, networking, storage, and dynamic power provisioning. They are making it so complex to run a modern data center that enterprises have no choice but to use Nvidia's proprietary software stack, effectively creating a massive ecosystem lock-in that makes it almost impossible for a company to switch to cheaper AMD chips or internal custom silicon. However, this ecosystem lock-in is facing an immediate multi-billion-dollar threat from an unexpected source: the rapid rise of efficient 4-bit quantization and specialized inference accelerators. Models like Llama 4 Scout and Maverick can now run at extreme speeds on a single rented GPU, or highly optimized, low-cost inference chips like Grok. Startups and enterprise companies are realizing they don't need to buy a $1 million Nvidia NVL72 rack to run cutting-edge AI. They can self-host open weights models for a fraction of the cost,
which is putting immense downward pressure on Nvidia's pricing power. This brings us straight to the core vulnerability of Meta platforms that could absolutely derail their journey to a $1,000 stock price. Zuckerberg's projected 2026 capital expenditure of over $115 billion is an absolute monster of a budget that is eating deep into their capital reserves. If the monetization of Llama 5 through advertising and wearable hardware takes longer than expected to show up on the bottom line, institutional investors will lose patience, just like they did during the metaverse crash of 2022, when Meta shares plummeted below $90. One bad quarter showing a slowdown in ad revenue, paired with rising infrastructure costs, could trigger a massive panic. But Meta has a secret weapon that Nvidia can never replicate: an active user base of over 3.5 billion daily active users across its family of apps. This is the largest proprietary dataset on the face of the earth, and in 2026, data is the ultimate oil. Every single time a user clicks, posts, comments, or views a video on Instagram or Facebook, they are providing free, high-quality training data to make Meta's AI models smarter. Nvidia has to spend billions trying to simulate data or partner with content creators, while Meta gets a continuous, infinite stream of real-world human behavior data completely for free.
Converting attention into cold, hard cash. Think about how this data advantage translates directly into corporate profit. Advertisers are flocking to Meta because their AI systems can now automatically generate ad creatives, test thousands of variations in real time, and pinpoint the exact consumer ready to buy a product with terrifying accuracy. This has caused Meta's operating cash flow to explode, giving them a massive war chest that allows them to fund this aggressive AI arms race completely internally, without taking on a single dollar of high-interest debt, making them one of the most financially resilient companies on Wall Street. Meanwhile, Nvidia is running into a severe physical wall that money simply cannot solve: the global power crisis. Me's new Vera Rubin AI factories require an astronomical amount of electricity, with a single modern server rack drawing hundreds of thousands of watts of power. Data centers are maxing out the power grids of entire cities, and tech companies are realizing that even if they want to buy more Nvidia chips, they literally cannot find the electrical capacity to turn them on. This power constraint is putting a hard ceiling on Nvidia's hardware sales growth for the rest of this year. To combat this, Nvidia is heavily promoting their DSX Max-Q platform, which enables dynamic power provisioning to squeeze 30% more infrastructure into fixed power data centers. Jensen Huang is trying to position Nvidia as an energy efficiency company, arguing that buying more expensive Rubin chips actually saves money on the corporate electric bill. It's a brilliant marketing spin, but it doesn't change the underlying reality that the physical limits of our energy infrastructure are actively slowing down the pace of massive GPU cluster deployments worldwide. At the exact same time, Meta is facing its own intense legal and regulatory battles that keep many conservative investors up at night. The company is currently battling hundreds of high-profile lawsuits regarding the social impact of its platforms on the mental health of minors, alongside intense scrutiny over AI hallucinations and deepfakes. If a major regulatory body passes sweeping legislation targeting open-source AI safety, or if Meta faces a massive multi-billion-dollar fine, the stock will take a severe hit, proving that being the world's open-source AI leader comes with an enormous target on your back. So, when we strip away all the superficial marketing hype, the high-profile CEO keynotes, and the complex technical jargon that Wall Street uses to distract everyday investors, which of these two technology giants represents the absolute best buy for your hard-earned money right now in 2026? To accurately answer that question, we must look far beneath the surface and analyze the exact risk-to-reward ratio for both companies over the next 12 to 18 months. Nvidia has had an absolutely legendary, historically unprecedented financial run, completely defying all the short sellers and firmly cementing its place as the foundational infrastructure engine of the entire digital universe. However, its current $5 trillion valuation means it is priced for absolute flawless perfection, leaving zero room for human error, execution delays, or structural market corrections. If you choose to buy Nvidia today at its current price of $224 a share, you are intentionally paying a premium price-to-earnings multiple at the exact cyclical moment when its primary hyperscaler customers are aggressively looking for ways to cut down on their massive hardware spending. The highly anticipated commercial launch of the Rubin architecture platform in late 2026 will undoubtedly generate massive mainstream media headlines and viral social media buzz. But it also fundamentally marks the transition of the chip sector into a mature market, where physical manufacturing supply is rapidly catching up to enterprise demand. The easy, explosive wealth-building phase of Nvidia stock is officially behind us, and from this exact point forward, the potential upside is significantly capped, while the structural downside risk grows larger with every single tech conglomerate that finishes building out its sovereign data centers. When you buy a hardware cyclical stock at the absolute peak of its demand cycle, you are committing a cardinal sin of long-term value investing. The reality is that data centers are capital-intensive, long-duration assets, and once the baseline global infrastructure layer is laid down, the frantic purchasing of high-margin GPUs slows down from an avalanche to a trickle. This transition is an existential threat to anyone FOMO buying into Nvidia at a $5 trillion market cap, because a hardware company cannot easily pivot its revenue model to recurring software subscriptions overnight, when its core physical product lines experience a sudden drop-off in order volumes. Meta, on the other hand, represents the exact opposite structural scenario. It is a highly profitable, high-growth tech giant that is being completely mispriced, misunderstood, and fundamentally unloved by a broader market that doesn't fully grasp the long-term compounding power of a dominant open-source software ecosystem. Trading around $604 a share with a forward price-to-earnings ratio of just 24 times, Meta is actively growing its top-line sales at an incredible 33% clip, while trading at a massive, irrational valuation discount relative to its mega-cap technology peers. If Meta's conservative valuation multiple simply adjusts to a reasonable, historical 19 times its operating cash flow, the mathematical modeling shows the stock will naturally rocket to a brand new all-time high of $920, and continuous strong corporate earnings throughout the year will easily push it past the historic $1,000 milestone. Think about the incredible, mathematically protected asymmetric bet that Meta offers your investment portfolio right now. If the broader global AI revolution experiences an unexpected temporary slowdown, an industry-wide regulatory cooling-off period, or a temporary capital expenditure fatigue, Meta's downside is highly insulated because they possess a booming, highly lucrative core digital advertising business supported by over 3.5 billion daily active users that continuously spins off billions of dollars in free cash flow every single quarter. Conversely, if the AI revolution accelerates into hyperdrive, Meta wins massively because they own the dominant open-source foundational model ecosystem via Llama 5 and the absolute breakout consumer AI hardware interface via their smart glasses. This dual-engine growth framework makes Meta an absolute fortress in an uncertain economic climate. While other tech companies are bleeding cash trying to figure out how to monetize their artificial intelligence applications, Meta has already fully integrated advanced machine learning models directly into their ad auction algorithms, boosting conversion rates for small businesses and enterprise corporations globally. They have transformed AI from an experimental corporate research project into an immediate, high-margin revenue generator that funds their next-generation research completely organically, bypassing the need to borrow expensive capital in a high-interest rate macroeconomic environment. Nvidia is undoubtedly an exceptional, world-changing company run by a visionary, once-in-a-generation leader. But as an intelligent investor, your ultimate goal isn't to buy the company with the coolest tech products or the most charismatic chief executive. Your fiduciary goal is to systematically buy the specific asset that offers the highest statistical probability of outsized financial returns relative to the precise amount of capital risk you are taking on.
Nvidia requires absolutely everything in the global macroeconomic supply chain to go perfectly, just to maintain its current inflated price. While Meta can face intense regulatory hurdles, massive capital expenditure costs, and fierce competitive threats, and still see its stock price surge by 50% or more over the next year, based on pure, undeniable fundamental valuation metrics alone. Furthermore, we must look at the hidden costs of scaling hardware versus software, because this is where the divergence between these two corporate giants becomes an absolute canyon. For Nvidia to double its revenue from this point forward, it must physically secure double the amount of advanced silicon wafers from TSMC, source double the amount of ultra-scarce high-bandwidth memory, and convince global energy grids to provide tens of gigawatts of additional electricity to power their physical units. Meta does not face these physical boundaries. Once their open-source models are trained and deployed across their massive worldwide server architecture, serving those models to an extra billion users features near-zero marginal costs, enabling their operating margins to expand exponentially. The institutional rotation of smart money out of expensive, hyper-cyclical semiconductor hardware and into cheap, cash flow-rich, high-margin AI software platforms is already actively happening right under our noses, and fighting against that structural macroeconomic trend is a losing battle for retail investors. Mark Zuckerberg has successfully and brilliantly navigated the complex corporate transition from a legacy social media platform to an absolute artificial intelligence and wearable computing powerhouse, proving the institutional doubters completely wrong and setting up a crystal-clear path to immense, multi-decade profitability. When you look at the entire macroeconomic board, the strategic choice becomes remarkably clear for any disciplined investor looking to deploy real capital right now. Nvidia is a spectacular foundational hold if you were smart enough to buy it years ago at a low-cost basis. But it is an incredibly risky, low-reward buy at its current $5 trillion peak. Meta Platforms is the absolute best stock to buy right now in 2026, offering you a rare, generational combination of explosive AI software upside, massive fundamental downside protection, a highly compressed valuation multiple, and an incredibly clear runway to cross the $1,000 per share milestone before this calendar year comes to a close. Stay disciplined, trust the underlying cash flows, and position your hard-earned capital where the real long-term value is being created.
If you want more videos like this on stocks, subscribe now. I break down real opportunities, not hype.
The content provided in this video is for educational purposes only. It should not be considered as financial advice or a recommendation to buy or sell any securities. The information presented is based on our research and analysis and is intended to help viewers understand market concepts and strategies.